Hi, Anthony here, and welcome to my video. I want you to take a close look at the image on the screen. Usually we talk about these markets in isolation, but right now something rare is happening. Gold, silver, and platinum are breaking out together. This isn't just a coincidence, it's a unified rally. The last time we saw a synchronized move like this was back in the late 1970s, and historically, that signals a massive shift in investor sentiment away from paper currency and into hard assets. So the big question is, what is the powerful force driving them all at the same time? The answer lies in what we call fiscal dominance. If you look at this diagram, you can see the trap the financial system is in. Interest payments on US government debt have surpassed $1 trillion for the first time, with a 2025 deficit projected at $1.8 trillion. The government effectively needs to stay solvent. This means central banks are no longer fully independent. They are forced to keep rates low to manage those debt payments, even if inflation runs hot. As real yields on bonds compress towards zero, investors naturally start looking for assets that can't be printed. The smart money, the central banks themselves, are already positioning for this. Look at the map here. We are seeing a structural rebalancing where institutions are moving away from paper assets and into physical gold. Last year alone, central banks purchased over 1,000 tons, the third largest expansion on record. Look at Poland. They've actually overtaken the ECB's gold reserves. Because these banks are buying for insurance rather than profit, they are price insensitive, creating a sovereign put, a price floor under the market that simply didn't exist a decade ago. Let's translate that fundamental support into the technicals. Looking at this chart, you can see how the structure has changed. What used to be a ceiling has transformed into a powerful new trampoline of support at the $4,000 level. Dips are being convincingly slurped up. Major players like Goldman Sachs are forecasting upside to $5,000, driven by the fact that demand is outpacing supply while mine output remains flat. Now let's rotate to silver. While gold is the monetary hedge, silver is powering the green revolution. This chart breaks down the demand. Solar panels alone now consume about 25% of mine production. And here is the kicker. The new technology, HJT cells, uses 70% more silver than the current tech. When you combine that with the fact that China installed more solar capacity in 2024 than the US has in its entire history, you see why demand is becoming insatiable. But here is the problem for silver. We are running out of it above ground. As you can see here, the market has been in a structural deficit for 5 consecutive years. Mine production actually peaked back in 2016. Because 70% of silver comes as a byproduct of mining other metals, producers can't just easily ramp up supply because the price is high. We are looking at a cumulative deficit since 2021 that exceeds 796 million ounces. Technically, this supply crunch has led to a massive breakout. Look at this 44-year resistance line on the chart. We have smashed through a ceiling that held for nearly half a century. This signals a fundamental change in market structure. If the gold-silver ratio moves back toward its historic average of 62, we could be looking at silver prices in the $60 to $68 range. Moving on to our third metal, platinum. This is a story of industrial substitution. When palladium prices spiked a few years ago, automakers began retooling to use platinum instead. As this diagram shows, it's a one-to-one switch, but once that decision is made, the demand is locked in for the vehicle's 7-year life cycle. Automakers are currently swapping about 1 million ounces per year. The supply side for platinum is perhaps the most precarious of all. Look at where the resources are located. 70 to 80% come from the Bushveld complex. These are aging, deep mines facing power outages and labour disputes. Because of this concentration risk, we are on track for a deficit of nearly 700,000 ounces this year. Lease rates have spiked to over 10%, which tells us there is extreme physical tightness in the market right now. However, platinum has the hardest technical work to do. See this red zone on the chart? We call it the Great Wall of Supply. Previous rallies were violently rejected here, but as a deep value play, it is trading at a roughly 60% discount to gold. If it can chew through this supply zone, the upside is significant. So to wrap this up, think of these three metals as different plays on the same macro trend. Gold is your monetary insurance policy against fiscal dominance. Silver is your speculative bet on the green energy transition and supply deficits. And platinum is your deep value industrial play based on substitution and geological constraints. So as we look at the road ahead, I want you to walk away with 4 critical realizations. First, understand that this rally is a symptom of a deeper structural shift called fiscal dominance. Central banks are trapped by debt, forcing them to keep real rates low, which naturally pushes capital toward hard assets. Second, the market has a new dominant player. Central banks themselves are the new whales. Their relentless price-insensitive buying has fundamentally altered the floor price for gold. Third, on the industrial side, supply simply cannot keep up. We are seeing profound, multi-year deficits in silver and platinum that are colliding with powerful new demand sources. And finally, while this is a unified macro trend, remember that we have 3 metals, 3 stories. Each has its own unique bull case and investment thesis that you need to evaluate individually. Of course, we have to be realistic about the risks. Gold is currently extended, trading 20% above its 200-day moving average, so a pullback is historically likely. Silver is notoriously volatile and can suffer if sentiment shifts. And if central banks suddenly pivot to a hawkish policy to fight inflation, that would be a major headwind for all 3. But looking at the big picture, the trend is clear. This final image sums it up perfectly. We are witnessing the great revaluation. Government bonds no longer offer the safety they once did, and capital is structurally rotating into hard assets. The unified breakout is just the beginning. Thanks for watching.